wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 221, and in this episode we're reviewing the performance of the financial markets during the 28th week of 2026, and that is from Monday the 13th to Friday the 17th of July. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where on Tuesday, the 14th of July, the Bureau of Labor Statistics reported that consumer prices posted their biggest decline in more than 6 years during the month of June, as a sharp drop in energy prices provided a temporary relief from the recent surge in inflation. The Consumer Price Index, which is a broad measure of the cost of goods and services across the U.S. economy, showed that the annual rate of inflation fell from 4.2% in May down to 3.5% in June, and this was well below the consensus estimate for a rate of 3.8%. Meanwhile, core inflation, which excludes food and energy prices, this rose at an annual rate of 2.6%, which was also lower than the consensus forecast of 2.9%. The Bureau of Labor Statistics also released data on wholesale prices, which unexpectedly fell in the month of June as sliding energy prices helped to brighten the inflation outlook. On an annual basis, the Producer Price Index posted a seasonally adjusted inflation rate of 5.5%. And in related news, in his remarks to Congress on Tuesday, the Federal Reserve Chairman Kevin Warsh reiterated his call for a regime change at the central bank, calling inflation an unfair burden on the American people. The chairman said that he plans to get rid of inflation, which has been a tax on the American people and businesses. Warsh ramped up his recent tough talk on inflation while also touting the strength of the U.S. economy and the benefits coming from business investment, particularly in artificial intelligence. On U.S. economic outlook, according to the latest CNBC All-American Economic Survey, despite a booming stock market and improving inflation numbers, the U.S. public is depressed about the U.S. economy and increasingly concerned about the cost of everyday goods and services. The survey found that 61% of the public is pessimistic about the current state of the economy and about the outlook for the future. This is the highest percentage since December 2023, when the country was just emerging from the pandemic-era inflation. And also based on this survey, only about 25% of Americans are optimistic about the economy now and for the future. On Wall Street this past week, Stocks fell again on Friday, with Wall Street posting a weekly decline as traders weighed the latest developments in the semiconductor sector alongside escalating tensions in the Middle East. The latest development is competition from open source models in China, which are reportedly performing as well as, if not better than, leading AI models from Anthropic and OpenAI. And as a consequence, this is raising fresh concerns about the heavy pace of technology spending by American companies. All the three major indices recorded weekly losses, with the broad market S&P 500 falling by 1.6% to end the week at 7,457. And as tech stocks came under scrutiny, the tech-heavy Nasdaq Composite declined by 2.9% for the week to close at 25,520. And last but not least, the Dow Jones Industrial Average fell by 0.9% during the week to eventually settle at 52,146. In the government bond market, Treasury yields were mixed on Friday as investors digested a raft of data releases that indicated the U.S. economy continues to withstand inflationary pressures, as both consumer and producer price inflation declined in the month of June despite the ongoing and escalating conflict in the Middle East. The yield on the short-dated 2-year Treasury note, which typically moves in line with short-term Federal Reserve interest rate decisions, was up by more than 2 basis points to close at 4.17%. Meanwhile, the yield on the benchmark 10-year Treasury bond, which is a main reference for mortgages, auto loans, and credit card debt, dropped by more than 2 basis points to settle at 4.54%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another. In the commodity markets, oil prices rose on Friday after Kuwait said that Iran had attacked a power and water desalination plant as fighting escalated in the Persian Gulf. According to the Kuwait Times, the attack damaged the facility, sparking a fire that affected a large number of its electricity generating units. In retaliation, the U.S. Central Command also said it had completed its 7th consecutive night of strikes against Iran, hitting dozens of military targets. In response to the foregoing, the price of the international benchmark Brent crude advanced by about 4.6% to close at $88.10 per barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, gained by about 4.5% to finally settle at $82.49 per barrel. In the precious metals market, gold was on track for its biggest weekly loss in the past 6 weeks on Friday as escalating clashes between the US and Iran lifted oil prices, adding to inflationary pressures and strengthening the case for higher US interest rates. Geopolitical risks in the Middle East and its impact on inflation and interest rates remains the dominant force that is pulling back the price of gold. The surge in oil prices is reigniting concerns about inflation and increasing the likelihood of interest rate hikes. Higher interest rates tend to reduce the demand for gold, which is a non-yielding asset, as investors gravitate towards assets with a regular yield, such as treasury bonds. In response, the precious yellow metal fell by 3% this past week, its largest decline since the 1st of June, as the price of spot gold finally settled at $4,015 per ounce. Up next is a quick overview of the African financial markets. And we start by looking at Nigeria's consumer inflation, where the Statistics Office said on Wednesday that Nigeria's headline consumer inflation was broadly unchanged at 15.91% year-on-year in the month of June, a slight dip from 15.93% in May. Inflation began accelerating in March after the US and Israel attacked Iran, lifting global energy prices and snapping an 11-month run of easing price pressures in Africa's most populous country. The National Bureau of Statistics said that food inflation, which is a key driver of overall prices, accelerated to 17.52% year-on-year in June, up from 16.96% in the month of May. Staying in Nigeria, Aliko Dangote is nearing the completion of a $2.5 billion private share placement for his refinery business, marking a major step towards what could become Africa's largest initial public offering. The private share placement has valued the refinery at about $40 billion. This private offering attracted around $4 billion in investor demand, with support mainly coming from regional institutional investors. It is highly likely that an IPO could follow as early as August, aiming to raise an additional $1.5 to $2 billion through a public listing on the Nigerian exchange. The Dangote refinery, which began production in 2024, plans to boost its capacity from 650,000 to 1.4 million barrels per day by 2028. We now change scene to the Kenyan financial market, and we start by looking at the domestic foreign exchange market, where during the past week the Kenyan shilling continued trading within a very narrow range versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.34, and this is compared to a rate of 129.22 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.62 and the euro was valued at 147.77. And on the regional front, one Kenyan shilling was changing hands for 28.52 Ugandan shillings and 20.35 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.34. Despite the ongoing conflict in the Middle East and the subsequent increase in oil prices, the Kenyan shilling continues to remain extremely stable versus the US dollar, and the data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased for the third week in a row, but this time by a relatively modest amount of just $42 million for a grand total of $14.16 billion, which is equivalent to 6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and this is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024, with the maturity of Kenya's debut Eurobond for $2 billion. On diaspora remittances, the inflow of foreign exchange remittances into Kenya totaled to $375 million in June 2026, and this is compared to $394 million that was received in May 2026, representing a decrease of about 4.7%, and this was mainly attributed to lower inflows from key source markets such as the United States and Europe. In the meantime, the cumulative remittance inflows for the 12 months to June 2026, this decreased by 2.4% to $4.96 billion, and this is compared to an amount of $5.08 billion that was recorded for a similar period in 2025. The inflow of remittances remains an important source of foreign exchange earnings for the country and continues to support Kenya's balance of payments as well as the domestic foreign exchange market. In the money markets, during the past week, the liquidity situation in the interbank market was sufficient to meet demand for overnight lending, and this was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka KESONIA, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 24 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 16th of July, and the central bank received bids totaling to 44 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 157%. The central bank accepted 30.6 billion shillings, and the results of the auction were as follows. The 91-day rate took a dip of about 3 basis points to close out at 8.79%, whilst the 182-day rate was broadly flat at 8.96%, and the 364-day rate rose by about 5 basis points to finally break above 9% before settling at 9.04%. Over the past few weeks, the Treasury yield curve has been rising steadily, and this is on the back of increased government borrowing as the Treasury seeks to plug a budget deficit for the current financial year 2026-2027 that is estimated at about 1.2 trillion shillings. And in addition to this, the latest data shows that inflation is trending higher, and this is mainly driven by rising fuel prices due to the ongoing conflict in the Middle East. And as a consequence, we should therefore expect more upward pressure on interest rates as investors demand higher yields in order to offset the impact of inflation. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent for the government of Kenya, is inviting bids for 2 reopened fixed coupon treasury bonds in which it is looking to raise a total of 40 billion shillings for the stated purpose of budgetary support. The terms and conditions of the bonds are as follows. The first bond is a 20-year bond that was initially issued in 2019 and now has 12.8 years left to maturity. This bond matures in March 2039 and has a coupon rate of 12.87%. And the second bond is a 25-year bond that was initially issued in 2022 and now has 21.4 years left to maturity. This bond matures in September 2047 and has a coupon rate of 14.18%. These bonds are now open for sale until Wednesday, the 22nd of July, when the auction will be held. In the secondary bond market, the Central Bank of Kenya had previously published a prospectus for a switch auction in which it was inviting the current holders of a 5-year treasury bond that matures in November 2026 to switch their investments into a 20-year treasury bond that matures in November 2032. The auction for this switch was held on Monday, the 13th of July, and the central bank received bids totaling to 8.1 billion shillings against an advertised amount of 10 billion shillings, representing a performance rate of 81%. However, the central bank ended up accepting only 7.9 billion shillings at a weighted average rate of 12.80% compared to the destination bonds coupon rate of 12% flat. Up next is our topical issue, and this week we're looking at 2 issues. The first is Kenya's ability to attract a record amount of $3.2 billion in foreign direct investments in 2025. The United Nations Conference on Trade and Development reported in its World Investment Report dated 2026 that foreign direct investment inflows to Kenya rose by 38% to $3.2 billion in 2025, and this was up from $2.3 billion in 2024. Kenya attracted an estimated $3.2 billion in foreign direct investments in 2025, marking its strongest performance ever as investors poured money into the country's digital economy and renewable energy amid business-friendly reforms. The numbers released on Tuesday by the United Nations Conference on Trade and Development showed FDI inflows rose by 38%, which is equivalent to $876 million, up from a revised $2.3 billion in 2024. This achievement has helped Kenya to cement its position as East Africa's fastest growing investment destination, and this is despite a fierce global race for investment capital. The second issue is on Kenya looking to borrow an additional 65 billion shillings using another samurai bond. Kenya is eyeing an additional borrowing of 65 billion shillings from a Japan-backed samurai bond for the current fiscal year as the government looks to broaden its sources of funding. Last month, Kenya drew down its first samurai bond of about $171 million, which is equivalent to 22 billion shillings, earmarking the funds for the manufacturing and energy sectors. In this financial year, Kenya is targeting to borrow $500 million, which is equivalent to 65 billion shillings, using the samurai bond. The government has targeted to borrow 116 billion shillings from external lenders in the current financial year, and on an overall basis, the government's fiscal deficit for the financial year 2026-2027 stands at 1.14 trillion shillings, with the domestic market expected to contribute about 1.03 trillion shillings to plug this deficit. Kenya has long floated the idea of using samurai bonds to diversify its external borrowing away from dollar-denominated facilities, including commercial debt such as Eurobonds and syndicated loans. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the best way to find yourself is to lose yourself in the service of others. A quote by none other than Mahatma Gandhi. Think about it. Thank you, and God bless.